Sandeep, hi, morning. Good to have you on the show. Sandeep, now we've got the currency tailwind as well acting for IT. Not much to lose from here, you think? Because the stocks have already begun their move up.
Yeah, hi, good morning, and thanks for having me on the show. So, yes, you know what happens is with 1% rupee depreciation, you make around 30 basis point of margin increase at the EBITDA level. And that is what, if you see, people are counting 3 to 4 rupees change, which has happened in last few months. So, basically, 100 basis point improvement in EBITDA, and then they, extrapolate that into EPS growth, which comes to 4 to 8%, depending on what is the current margin status of the company. And that is the reason you are seeing this kind of move. But remember that that is true only till EBITDA level. Below that, most of the companies have a moving rolling forward hedge. And so you will book losses in the other income and you will see delta in revenue and EBITDA level. So I think, net, you won't make much from here. But yes, in the current situation with rupees falling, people are trying to find a hiding place and they are rightfully hiding in the space where there is a least impact of, or there is a beneficial impact of rupee depreciation.
Okay, so Sandeep, does that mean that this tailwind of sorts that we are seeing in IT over the last few days sustainable in your opinion? And in terms of the price to earnings valuations, they're trading at a significant discount to their 5-year averages. You believe that that's justified?
No, so 5-year average may not be right way to look at it, because also 5 year back the growth rates were different and today the growth rates are different. The size of the companies have changed meaningfully. At this size, to grow at 5-year-old level will also be tough. I believe that if you see fundamentally, then to the peg ratios are very important for us, and they range between 3 to 8 times depending on the type of company you're looking at. And 3 to 8 times, honestly, quite expensive in my opinion for a sector which is broadly penetrated in its biggest market, that is US, and also reasonably penetrated in Europe and UK. So I don't think that there is a lot of money to be made. Yes, it is a good hiding place. If rupee stays at 90, 91, 92, will it be able to take care of the wage hike next year? Yes, that is also true. It will be able to take care of wage hike. But at the same time, will there be a dollar revenue growth which is exciting? Will there be a real PAT growth X of currency which is exciting? I don't think so. So that is the way I look at the sector.
Okay. Sandeep, if I were to push you to give us some of your favorites within the Nifty IT pack, so large and mid, what would those be, if at all any are on your list?
So we believe that you have to be in ER&D space rather than traditional IT services. And in ER&D space, there are a lot of companies which everyone are aware, like KPIT, Tata Elxsi, Tata Technology to some extent, and L&T Technology Services, and so many names are there. Only challenge is there again, if you see, the growth rates will be, let's say, 12 to 14%, and the multiples are at 35 to 45 times. So I don't know whether it really makes sense to buy so expensive, because the challenge is that, the growth rates are not going to change meaningfully from here. And given that scenario, and once rupee stabilizes, what will be the next trigger which will drive your growth? So that is very difficult to find. Yes, I believe that ER&D is a space which will structurally grow at 2.5 times of the typical IT services space. So if you are bound to want to surely be having some exposure in the IT sector, then probably choose some ER&D names which are beaten down right now, and look at them, and you can buy them and hold them for long term. But definitely not the typical IT services, because in IT services the challenge is that the growth will not come for at least 12 to 18 months, at least maybe more, because of two reasons. One, there is no growth any which ways because of high penetration in their biggest market. And second is that the AI is cutting down efforts at very high pace. So, to even cover those losses is a huge task. So I will say that if you see numbers on dollar terms, you will not see any excitement. If you convert that and see in rupee terms, yes, there will be some excitement because of the currency benefit which is there.
Sandeep, do you still think that the story that played out about 2 years back, wherein niche AI-driven IT plays, or rather tech-driven IT plays, specialty plays, were the ones which outperform, namely from within the mid-cap universe, as opposed to IT services, the large-cap ones? Do you see that trend play out once again? Because even if I look at the screen now or in the previous week, it's the same names which are actually outperforming.
Absolutely. So, that is the reason for that is that, they have a benefit of size. So their size is small. So, and what has happened because of technology disruption of digital coming in and, COVID, small deals started coming more. And for small deals, even the smaller and mid-sized companies, which earlier were not able to participate with those clients, have got an opportunity. And that is the reason if you go by client, top 100 clients, all these mid-sized companies, whether it is LTI, Mindtree, or any of them, Coforge, they have gained substantial market share in those clients. And I think, with AI coming in and if deal sizes go further down, probably again, these companies will be the beneficiary. But now I think you should go down one level more and you find out companies which are of the size which the today's mid-cap were 5 years back, and, look at them. They can also become beneficiaries slowly because every disruption is cutting the size of the deal and shortening the execution cycle, which means that you will need more and more players to work, which means that you have to give an opportunity to smaller and smaller players. So we see a lot of opportunity in small and then mid and then large. So large is good for dividend and stability of the portfolio. Mid is decent, small, low end compounders, and small could be the ones which can definitely give a big boost to your portfolio. That is the way we build, and that is the way we look at it.
Okay, and Sandeep, I know that of course you're predominantly tracking IT, but now I mean you're also a fund manager. What are the pockets? What are the pockets of opportunity you're seeing in the market currently outside of IT? Is there something that's looking extremely interesting to you? I know you can't talk stocks, but even sectors.
So we are very, very positive in, this platform plays because we believe that platforms will be the biggest story. So any of the platforms, whether it is Swiggy, whether it is Urban Company, all the platforms, we are big fan of them and we have been holding quite a good position in them. And the reason is simple. We believe that, now capital and asset sweating is behind. Now it is manpower sweating, which is started picking up, and any platform which is able to sweat the platforms, they will sweat the labor resource through platform will make big money. So that is our one choice. Second, capital markets, because we believe capital market penetration is very low. So sooner or later, the penetration is bound to go up as per capita income goes up. The money which goes for saving increases, and saving will find its way into different asset classes, and equity will always be a preferred asset class. So we love capital markets. We love platforms. We love some bit of manufacturing, and we are also liking some companies which are conglomerates which have multiple businesses under them. So that is the way we are seeing at the stocks, and I believe there is a lot of money to be made. Yes, we are going through some tough time in the mid and small cap space, but fundamentally, I think the earnings growth in mid and small is much higher than the large. So it is just a matter of time when they will start picking up.
Okay, Sandeep, great to have you on the show. Thanks as always for your time.
Thank you.